All right, our last subject here is to generate the financial ratios table. As you can see, we have 2 years of financial statements, and all of these financial ratios are calculated based on the numbers on the financial statements, either in income statement or balance sheet. And right here, I have a copy paste the formula for all these ratios from our book chapter, and you can use this formula as reference when you conduct the calculation. And also, you can see that I have already put the right formats for you. These are all numerical numbers. As you can see, if I click on any of them, these are all numbers, but several of them are expressed in percentage, and some of them are expressed with a number and a customized letter following the number. And here you got the word days after the number result. So all of these numbers are need to be calculated based on the formulas. All right, since I know all these formulas, so I'm gonna delete that, and then we're gonna do this calculation. So let me just first close my picture here, and again, we want to be smart about doing the calculations. So you can once again make sure only one Excel file is opened up on your computer, and hit the button view, and then hit this button for new window, and then you're gonna have two windows showing up, and you want to view them vertically. All right, hit arrange all under view, and then you want to hit this vertical. And now we're talking. So these are the numbers to be calculated. And here on the right hand side, you have the reference file. So now we can get started. All right, so the first one is a current ratio, which is current assets divided by current liabilities. So you need to carefully look for the numbers from the balance sheet in the given spreadsheet. All right, and one thing you can do is just to drag it all the way to the right, nice and easy, and then the calculation will be replicated. For the quick ratio, it is current assets minus inventories divided by current liabilities. All right, as you can see, I hit 3 cells, and that's how I generate this quick ratio. And another way to do it is to use all the items excluding inventories within current assets. So within the current assets, you have a cash, account receivable, and the inventory. And the numerator of the quick ratio is current assets excluding inventories, which means only cash and accounts receivable left. So you can just simply put a cash plus accounts receivable as a numerator divided by the same denominator of current liabilities. You will get the same result. You can drag it now, or you can drag it later to the right for the previous year. And for the total assets turnover, it is a sales divided by the total assets. Okay, so let me zoom out. I can't now. All right, total assets. All right, and I need to zoom out a little bit so I can see both of the numbers in the same screen. All right, and for the inventory turnovers, so you can use sales divided by inventories only, not the entire total assets. And for account receivable turnover, the numerator still is sales divided by accounts receivable, change of denominator. And for average collection period, it is 365 days in a year divided by the account receivable turnover. You see account receivable turnover, which is 8 right here. That means on average during each year, your bill is collected 8 times from its first generated, issued, invoiced to the buyer, and then you're gonna collect the bill back. So on average, this process takes 8 times. And if you use the number of days divided by that turnover number, that's gonna be the number of days or the length of time to collect your bill just once, to do the replacement or the process just once. And for the same reason, day sales in inventory ratio, which is 365 days divided by the inventory turnover. All right, same result. Okay, same way of calculation. And for time interest earned ratio, that measures the firm's short-term solvency. So you're gonna use earnings before interest and taxes divided by interest. So we want this number to be high because we want to have a big enough EBIT, which is operating income, and a small enough interest payment. And for cash coverage ratio, it takes EBIT plus depreciation. So you recoup the non-cash effect of depreciation divided by interest. All right. And for total debt ratio, it is your total liabilities divided by total assets. An equity multiplier is another way to express the level of debt. So you're going to use total assets divided by the total equity. Long-term debt ratio is long-term bonds divided by total assets. Okay, and these three ratios basically measure the firm's level of borrowing, or we call it leverage. And you also have a group of profitability ratios. The first one is net profit margin, and you're gonna use the numbers from income statement. In particular, it is net income divided by net sales. And a return on assets would be the net income divided by total assets on the balance sheet. And the return on equity is net income divided by total liabilities and equity on the balance sheet. As I said, you can just drag it, the whole area of the results, by one column to the right. So you have the results for the previous year. Okay, because all the numbers here, the reference numbers in dollar format, are next to each other, so dragging is completely okay. You don't have to lock any numbers before dragging. Since we have calculated the return on equity, or ROE, the net income divided by the total common equity in F19. All right, then you just drag it. Okay. And for return on equity, we have a calculate right here. And there's another way to do it by using DuPont method. In particular, you're going to get the product of assets turnover ratio, equity multiplier, and net profit margin. So one is about the efficiency of the operation, another is about the amount of debt or leverage, the third is about profitability. So the return for stock investors or equity investors depends on these three components: profitability, efficiency, and debt level. Okay, hit enter, then you drag it to the right. All right, and the next category would be the market ratio. Okay, any ratio related to the stock market performance. So you have market capitalization, which is the market price for each share of the stock multiplied by the shares outstanding. Okay, then you drag it. And for market book ratio, it is market cap, which is the market value of the equity divided by the book value of the equity. Oops. Zoom out a little bit. It is market value of the equity divided by the book value of the equity, which is a common stock on the balance sheet. Okay, earnings per share, it is the net income divided by numbers of shares outstanding. Okay, and the dividend per share is the amount of dividends in total divided by the number of shares outstanding. Okay, price per earning ratio or PE ratio is the price per share, which is given, divided by earnings per share. Okay, and you want this ratio to be a high number, definitely. Okay, so here, after I calculate all these ratios, I can just drag it by one column to the right. And once again, you don't have to worry about the format of the numbers. So if you check all the formulas are placed in right way, so if I hit Control plus tilde, you will see they're all calculated numbers. And in terms of format, here is the trick. So let's say if I put a number 2 here, or 2.5, and if I want to make this number in the same format with x, so if I put a letter x, that means this is just a mathematical ratio. It's not dollar, it's not percentage, it's not number of days. So I can just right click on the cell and hit Format Cells. And here I need to highlight number, and I want to choose Custom. All right, and I'm going to edit it, and I will put a 0.0, and then I will put a quotation sign, and here I gotta say times. All right, so that's one way to do it. So 2.5 times. And still you can see if I change the number from 2.5 to 3.5, it just the text is retained. If I do this 2.5 times, just simply type it, then Excel would recognize this as a text message. It's not a number, so it does not perform any calculation. So right here, if I put this minus 1, I would have a 2.5. But if I do this minus 1, then it cannot be used for calculation because this is a text. So therefore, you have to do the editing by changing the format instead of typing in the word. And I can also change the format to something else. For example, within the quotation sign, as the textbook suggests, I just put a x for times, the number of times. For example, current ratio is 3.3 times. That means current assets is 3.3 times of current liabilities. All right. Inventory turnover ratio is 4.9. That means sales is 4.9 times of inventories. All right. And I can also change this to percentage, to dollar figure. It's really your call how to do the formatting.